So guys, we're going to spend the first part of today going through some of the multiple choice at the end of chapter 6, and then we'll start back again on the lecture and go over some of the items that make up an integrated audit. Who'd like to kind of discuss the items we talked about yesterday? What are one of the important features in creating and planning for an integrated audit? What are one of those important things in planning for an integrated audit? Anyone? Suggestions? A testing of internal controls. And why is that testing of internal controls important for us? Because if we can trust those internal controls are in place, maybe we can do less testing on the certain account balances, because we know that the necessary controls are in place as far as signing off, approving bills, the necessary guidelines for the financial aspects of an audit. There's segregation of duties, there's approval of bills, proper authorization, paperwork backup. That really helps us to be able to have a sense of security in the controls in place, and as a result maybe we'll reduce various types of testing. So we finished with 627 discussing the integrated audit of sales and receivables, what's important for us. We're going to be concerned when managers just override credit policies in place, correct? Obviously the internal controls aren't working as they should be. Now, does that make us worry that the receivables existence isn't in effect? No, but the fact that we could potentially have some uncollectible accounts if they're overriding those credit limitations could be a concern for us. Let's look at 628. 628, we're working on page 294. Using the descriptive information in question 627, indicate the most appropriate action for the auditor to take regarding the expansion of substantive tests on sales and receivables. So basically we find out on 627 that we're looking at auditing sales and receivables and notes, and we come to find out the company doesn't follow credit policies, it overrides them. And the sales manager has the ability to override credit policies. And so what's our concern there? Would we expand the use of confirmations to determine the existence of customers with bad credit? Would we expand the search for new sales made to these same customers after year end? Use generalized audit software to foot the file of receivables to determine that all items have been recorded? Or would we expand the use of collectability tests, including aging of accounts receivable and reviewing credit scores, for a large selection of sales made during the latter part of the year, and an updating those procedures for estimating the allowance for uncollectibles? Guys, we know that the receivables are true. They're letting us know they do exist. Our concern is, because of the lack of following those credit policies in place, are we going to receive the money on those sales? Therefore, our concern doesn't have to do with do these sales exist. We know they're in existence. Our concern is more related to what's the likelihood that we might not collect all that money because they're not following the appropriate credit procedures for those particular clients. Does that make sense? 629. If management finds a material weakness in internal controls, but remediates the control before year end, and determines that no material misstatements have occurred because of the deficiency, the auditor should do which of the following? So management finds there's material weakness in internal controls but fixes it and then decides there's no material misstatement. Should we test the remediated control to determine that it's working effectively? Should we issue an adverse opinion because the control was not working effectively throughout the year? Should we expand tests of the affected account balances to develop an independent assessment as to whether there are material misstatements? Do we do all the above or only A and C? You know, I probably, I would agree with you, but the correct answer, in fact, is C. Excuse me. The correct answer is E. Gosh. I would agree here, and I'm thinking the correct answer is C. I would look at that control, make sure it's working, but then we need to independently go and examine the area and just see how things are working, right? We need to make sure that we perform the correct procedures. Since our name is the one that's being issued on an opinion on the internal controls, we need to make sure that we conduct the necessary testing to feel comfortable that those internal controls are in place. So you are right, the correct answer is E. Next, we're going to move on to 630. The auditor's test of internal control over financial reporting include all of the following except controls over disclosures, processes leading to accounting estimates, adjusting journal entries, determining the income tax liability, or all of the above are included in testing internal controls over financial reporting. We know we're interested in looking at those disclosures. We want to see how they come up with and derive their accounting estimates. We are interested in those adjusting journal entries. Who's recording them? Who's approving them? How do they calculate an income tax liability? And all of the above help us to determine that internal controls are operating efficiently. So the correct answer is E. 631. Which of the following would not be a primary consideration of the auditor in determining whether a deficiency was a significant deficiency or a material weakness? So what is the difference between a material weakness and a significant deficiency? I think we had this in a prior, in the chapter from the week, chapter 5. Let me look for, I think we got to there. Let's look for the difference, the definitions of material weakness and significant deficiency. So, so page 241 provides us with material weakness. A deficiency or a combination of deficiencies in internal controls over financial reporting such that there is a reasonable possibility that a material misstatement of the company's annual or interim financial statements will not be prevented or detected on a timely basis. So a material weakness is a combination of deficiencies or even one which potentially could cause a material misstatement. Significant deficiencies, a deficiency or a combination of deficiencies in internal controls that is less severe than a material weakness, yet important enough to merit attention by those responsible for oversight of the company's financial reporting. In layman's terms, a material deficiency is something that really could alter the financial statements. A significant deficiency isn't as severe, but definitely something to warrant looking at it and be mindful of it. Okay? So as we go back to this problem here, which of the following would not be a primary consideration of the auditor in determining whether a deficiency was a significant deficiency or a material weakness? A, the rate of failure of the control. B, the volume and dollar amount of transactions affected by the control. C, whether the control is computerized or manual. Or D, whether the control deficiency is mitigated by other control elements. So let's say we've got some issues that are concerning. There's a deficiency. Does it matter the rate of failure? Yes. If the rate of failure goes past a certain level, that's going to change from a significant deficiency over to a material deficiency, a material weakness. What if the volume and dollar amount of transactions are affected? Do we care if the volume and dollar amount is $1,000 versus $1 million? Yes. Significant, yes. Do we care if the control is a computerized control or a manual control? No. If a deficiency is a deficiency is a deficiency, right? No matter how it's computerized or manual, it's still a deficiency and warrants concern. So C would be the right answer there, guys. Okay, the next we're going to do 632. Which of the following are correct related to the auditor's tests of the client's monitoring controls? So the auditor's test related to clients monitoring the controls. The auditor should test monitoring only if the management's evaluation of internal controls indicates that management's relying on monitoring controls. Do we think that's important? 2, monitoring is a process to determine that other controls are working properly. Or 3, monitoring can substitute for a deficiency of other controls. Right now, 3 we know is not okay. Monitoring doesn't substitute for a deficiency in other controls at all. The auditor should test monitoring only if management's evaluation of internal controls indicates management is relying on monitoring controls. And also, the monitoring is a process to determine that other controls are working properly. So that correct answer there should be B. Now, last, as far as the multiple choice are concerned, all of the following would be included in the auditor's tests of controls over accounting estimates except confirmation of the estimate with outside third parties. Who would we confirm the estimate with outside third parties, guys? I mean, we confirm accounts receivable. How do we do that? We may, let's say we're showing on the books that they are due, let's say they're auditing a furniture store. And the furniture store shows on the books that there are some receivables due from Shoemake of $890, Hardwick of $1020, Toddley of $1,010. What's a way they might confirm those numbers are correct down the road? They might send out confirmations to us to say, this is what the records show, do you agree? Okay? That would make sense because those accounts receivable can be verified from outside the firm, the company. But how can accounting estimates, allowance for doubtful accounts, or depreciation be confirmed from outside the company? It's not going to happen. So the correct answer here is A, they're not going to test estimates through confirming outside. There's nothing to confirm outside. Does that make sense, guys? Any questions on that? So as we go back to looking at the PowerPoint, the one thing that I do want to spend some time on is really begin to understand the various assertions that management has about financial statements. And one of the slides that we talked about yesterday related to some assertions and how they test those assertions. Now this is really, as we move farther in this course, this is really the key. The whole reason that we're going to test various transactions is when we show financial statements, there are certain assertions management claims, such as the balance is right, that it includes everything, that we have valued assets appropriately, that we've included all transactions. There are various assertions such as completeness, that things really did occur, that we're not making up sales transactions, that we value things accordingly to GAAP. And the way we test these various assertions may be to go and look at a sales invoice and then go later to the next year and make sure that that money actually did come in, that it wasn't canceled. Now, there may be an instance where something is canceled, but if you see a history of that, then we don't really know if they in fact occurred as we're expecting. So this is something we are going to take some time to look at, these various assertions. Now, when we talk about looking at controls, seeing if they work, and we're going to look and see how good these controls are. Oops, sorry. And if the controls aren't very good, what we'll end up doing is trying to decide what kind of deficiency are they. Significant deficiencies or material weaknesses. What did we decide about material weaknesses? Is that greater than a significant deficiency or less? It's less. Significant deficiencies still are cause for concern, but not to the degree. We're going to decide then, based on all of our testing, can we keep, do we trust these controls? Do we need to change levels of control risk? And then how any deficiencies may ultimately change the type of testing we're going to do with the audit. Another thing that is at this phase of the audit we're going to start thinking about as an auditor: how much assurance can be obtained regarding audit risk when internal controls is present and working? So when we know internal controls are present and working, the audit risk is the risk that we issue an opinion that is in fact incorrect. Okay? So is the chances or the likelihood that we know internal controls are working, will that fact that these internal controls, after we've tested them, are in place and working, could that change how much we can trust that our audit risk may possibly alter as a result of knowing those internal controls are in place? If control activities within processes are working throughout the year, what is the residual risk that remains that an account balance can still be misstated? Again, let's say that control activities are in place. So our inventory, let's just take our inventory account. We know that there are processes in place to make sure that the shipments are checked off and match the packing slip, which ultimately matches the invoice. So the guidelines are really set up and are monitored and adhered to. Is there still a chance that even though these guidelines are adhered to, is there still a chance that the account balance could be wrong? There is, isn't there? But if we know these guidelines are really operating well, will that maybe alter the our ability to trust these account balances maybe a little more because the internal controls are in place? Which account balances contain more than an acceptable amount of risk that a material misstatement could occur? We're going to have to look at where could there be risky account balances. Let's just think of Built Right, guys. Just in doing our preliminary look at Built Right, what are we having a hard time maybe feeling good about? I don't know about you, but sales were how much up this year? Wasn't it significant? And so wouldn't we be a little like what is the likelihood in our mind that Built Right sales could be misstated? Or their cost of goods could be misstated? Something's misstated there? Because remember when we did that analysis, don't we think something is goofy just with the numbers? That the ratios for cost of goods sold to income, didn't it really go down this year? You guys remember that? So can we really trust? Don't you think somewhere, I feel like there is a great likelihood those balances are off somehow. Just because of our initial processes of looking at the analytical, those beginning assessments, I seem to think something does not feel like it is in sync with previous years. How would a material misstatement in a material account balance most likely occur? How does it happen? Well, in our situation just with sales, could sales have maybe been recorded before they actually shipped the goods? So you try to think through, how could it have happened? You process through where could we be off and how could it have happened? Could someone have possibly recorded the sales even though the goods hadn't shipped yet? That's probably what we're going to look for, aren't we? What are the most effective substantive tests of account balances to determine whether there's a misstatement in the account balance? So we're going to try to figure out what kind of testing do we want to do to check on how this account balance, where it could possibly be wrong. Okay, so basically, we're going back to this whole control environment, and we're looking at various risks associated with these balances. Remember, business risks are those risks just because of the company's operating in a certain market, in a certain environment. And how can management potentially be part and party to balances being off? And then we've got risks associated with the processes of accounting. And maybe, just from a well-intended accounting process, maybe just not having the best of judgment related to what accounts may be uncollectible. So the one thing that we're going to start understanding as we proceed with these chapters, there's various processes within a company, and those processes affect certain accounts. So we're going to be aware of what occurs when we're dealing with revenues and we're dealing with cost of goods sold? What accounts are affected with that? Revenues are affected, cost of goods sold and inventory gets affected, and of course our accounts receivables affected, because the whole revenue and cost of goods sold process are customers purchasing goods and the processes of recording those sales and associated accounts receivable and cash. And then making sure we reduce our inventory and debit our cost of goods sold. When we go out and purchase inventory, we've got to think of those accounts that are affected by that process. Of course, accounts payable, our inventory, we're purchasing those goods for inventory purposes, or maybe expenses. Some can be inventory, some could be expenses. And sometimes we're purchasing other types of assets. So we need to be aware of how each process affects certain accounts. Any questions there, guys? Does that make sense?
Yeah, what about, I remember when we were doing the project, you put on, plus last year, the end of principles too, about reporting the inventory on this year's versus the next, or get exactly how to.
Reporting inventory.
It was the way they reported the inventory at the end of the year that overstated.
If inventory is lower, so in other words, let's say that they understated inventory. What really happens if inventory gets understated in one period? Well, it screws up a couple years, right? Because if inventory should really be ending balance of 200, but we show the inventory ending balance is 100, then potentially what's happened here is we're showing there's a greater cost of goods sold than there really should be, okay? Which then is going to play out into the next period, that then cost of goods sold is really understated the next period, because inventory is going to affect a couple periods. Ultimately, in the big scheme, it's going to wash out. But between periods, it could be affected, which might be happening in built right too, don't you think?
Well, that's what we call it.
Exactly. So as we move on here, sometimes it's just